The disposition effect, selling winners and holding losers. Introduction. Imagine an investor who proudly sells a stock after it earns a small profit, feeling satisfied with their gain. At the same time, that same investor refuses to sell another stock that has been steadily declining in value, hoping it will eventually recover. This behavior, although common, is often irrational and can lead to poor financial outcomes. This phenomenon is known as the disposition effect. The disposition effect is a behavioral bias where investors tend to sell assets that have increased in value, winners, too early, while holding on to assets that have decreased in value, losers, for too long. This behavior contradicts rational financial theory, which suggests that investment decisions should be based on future expectations rather than past performance. Understanding the disposition effect is crucial for investors, financial analysts, and students of behavioral economics. It provides insight into how emotions and psychological biases influence financial decision-making. Meaning of the disposition effect. The disposition effect refers to the tendency of investors to quickly sell investments that have gained value and reluctantly sell investments that have lost value. This results in a pattern where profits are realized too early and losses are allowed to grow. Instead of making decisions based on logical analysis, investors are influenced by emotions such as fear, regret, and hope. Origin of the concept. The disposition effect was formally identified by economists Hirsch Sheffrin and Mayer Statman. Their research highlighted how psychological factors influence investment behavior. Their work challenged traditional finance theories, which assume that investors are rational and always act to maximize returns. Key features of the disposition effect. 1. Early profit booking. Investors prefer to lock in gains quickly to feel successful. 2. Reluctance to accept losses. Investors avoid selling losing investments because it means accepting failure. 3. Emotional decision-making. Decisions are driven more by feelings than by logic. 4. Reference point bias. Investors compare current prices to the purchase price. 5. Asymmetry in behavior. Different treatment of gains and losses. Psychological reasons behind the disposition effect. 1. Loss aversion. Loss aversion suggests that losses hurt more than gains feel good. Losing 1,000 Indian rupees causes more emotional pain than gaining 1,000 Indian rupees gives happiness. Because of this, investors avoid realizing losses and hold losing stocks, hoping to avoid emotional pain. 2. Prospect theory. According to this theory, people are risk-averse when dealing with gains and risk-seeking when dealing with losses. This explains why investors sell winners quickly and hold losers longer. 3. Regret aversion. Investors fear regret. Selling a loser means admitting a bad decision, while holding avoids regret temporarily. 4. Mental accounting. Investors treat each investment separately rather than as part of a portfolio. 5. Overconfidence bias. Investors believe their decisions are correct and that losing stocks will eventually recover. Examples of the disposition effect. Example 1. Stock market behavior. An investor buys stock A at 100 Indian rupees and sells at 120 Indian rupees, but buys stock B at 100 Indian rupees and holds it even when it falls to 70 Indian rupees. The result is a small gain realized and a larger loss unrealized. Example 2. Real estate investment. A person sells a property that increased slightly in value, but holds onto a declining property, hoping for future appreciation. Example 3. Cryptocurrency trading. Traders often sell coins after small gains, but hold falling coins expecting a rebound. Example 4. Mutual funds. Investors redeem funds with small profits, but continue holding poorly performing funds. Impact on investment performance. 1. Reduced returns. Selling winners early limits potential profits. 2. Increased losses. Holding losers leads to bigger losses. 3. Poor portfolio management. Unbalanced portfolios with weak assets. 4. Missed opportunities. Capital is stuck in underperforming investments. Empirical evidence. Research shows that individual investors are more likely to sell winning stocks and hold losing stocks longer than rational investors. Studies of trading data confirm this behavior across stock markets, mutual funds, and retail investors. Disposition effect in different markets. 1. Stock market, most commonly observed. 2. Cryptocurrency market, stronger due to volatility. 3. Real estate market, delayed selling of loss-making properties. 4. Commodity market, traders hold losing positions hoping for recovery. Factors influencing the disposition effect. 1. Experience level, beginners are more prone. 2. Market conditions, volatility increases emotional decisions. 3. Personality traits, risk tolerance affects behavior. 4. Financial knowledge, better knowledge reduces bias. Why investors fall into this trap. Emotional attachment, fear of realizing losses, hope for recovery, and social influence all contribute to this behavior. Real-life case study. A retail investor portfolio often shows profitable stocks sold within months, while loss-making stocks are held for years. The outcome is overall returns lower than the market average. How to overcome the disposition effect. Focus on future value instead of past price. Ask yourself, would I buy this stock today? Use stop-loss orders to limit losses automatically. Evaluate your portfolio as a whole rather than focusing on individual investments. Set clear rules for buying and selling in advance. Avoid emotional decisions and rely on data. Rebalance your portfolio regularly. Role of technology. Modern tools like trading algorithms, portfolio trackers, and robo-advisors help reduce emotional bias by relying on logic. Disposition effect in behavioral finance. The disposition effect is a key concept in behavioral finance because it challenges traditional theories, highlights the role of psychology, and explains market inefficiencies. Connection with other biases. Anchoring bias, sunk cost fallacy, confirmation bias, and endowment effect all contribute to the disposition effect. Implications for financial markets. It leads to market inefficiency, unusual trading patterns, and price momentum where winners continue to rise. Advantages limited. It may provide psychological comfort and prevent panic selling in some situations. Disadvantages. Lower returns, higher risk, emotional stress, and poor financial decisions. Practical tips for investors. Keep emotions separate. Think long-term. Use data-driven decisions. Review your portfolio regularly and learn from mistakes. Conclusion. The disposition effect is a powerful psychological bias that significantly impacts investment decisions. By selling winners too early and holding on to losers too long, investors often reduce their overall returns and increase their risk. Understanding this bias is the first step toward overcoming it. By focusing on rational analysis, setting clear investment strategies, and avoiding emotional decision-making, investors can improve their financial outcomes. In investing, success is not just about choosing the right assets, but also about avoiding the wrong behaviors.